Welcome back, everyone. Today we are talking about GRATs, kind of a niche wealth planning, estate planning strategy. And we just wanted to share some insight, what they are, how they work, who uses them, and kind of everything you need to know about GRATs. So, Matt, you're kind of our estate planning GRAT expert. Can you define what a GRAT is and explain it?
Yes, I can, Stephen. GRAT stands for Grantor Retained Annuity Trust. And so this is somebody putting an asset into a trust with, as the name implies, an annuity being retained. So somebody puts in an asset to the trust, gets back annual payments from that trust with whatever's left over at the end of the trust term in the trust being passed on to heirs is really the mechanics at a simple level.
Okay. And we'll talk about kind of why, obviously, someone uses this strategy. But first off, who should use it or who does use it in this case?
Yeah, GRATs are used by people who are either paying or worried about paying gift and estate taxes. And we'll walk through the mechanics of how those work. But basically, that's anyone with tens of millions of dollars or more. And as we'll discuss later on as well, there's public examples of some of the wealthiest people on earth having used GRATs to pass on wealth to their heirs in a tax-efficient way.
So people like Nike's founder Phil Knight, Mark Zuckerberg, Jensen Huang of NVIDIA, and then also, folks that really are above that estate tax exclusion. So right now, that exclusion is around $15 million per person, per couple, so $30 million. So if your estate, your assets are near that or above that, then this might be a strategy that you're looking at.
Yeah, and Stephen, to that point, the current exemption amount for lifetime gift and estate tax is $15 million per person, but things like GRATs can apply to people even if they're not there yet, but it reasonably expect they could be there at some point in the future based on either business sales or returns on their portfolio. And also, one other point to mention is the $15 million limit is not set in stone forever, and that could in fact come down at some point in the future, which doesn't seem likely given that the recent trend line has been steady increases since about the year 2000, but just something to be mindful of. That number is set by Congress, and Congress can change that number in the future.
Okay. So we've kind of established that GRATs are for folks that are above or close to that lifetime gift exemption limit, and that plays into why they are being used. So we want to kind of break this down a little bit further of the mechanics of GRATs, how they work, why they're beneficial, and just kind of a little bit more deeper dive into the strategy. So Matt, can you share with us a little bit about why they're useful specifically?
Yeah, so GRATs are useful because they're super efficient from an estate tax planning perspective. And the way that the gift amount is taxed at the setting up or establishment of the GRAT is there's basically two components to the value of the GRAT when you're setting it up. You put an asset in, and then you're setting up an annuity where you're getting payments from the GRAT back to you as the grantor. And so that annuity has a value assigned to it. And then there's whatever is left. So there's the contribution to the GRAT, there's the value of the annuity, and then there's the remainder. And the way that these things are often structured, especially by the uber wealthy, is what's called zeroing out the GRAT. So you set it up in a way such that the value of the annuity that you will be getting back as the grantor is equal to the amount of money you're putting into the GRAT. So you actually end up not using any of your lifetime gift or estate tax exemption. So, I mean, it can't get any more efficient than that from an estate tax planning perspective. And that's why these things are efficient and super popular.
Yeah. And as an add-on to that, the assets that you place in that remain in the GRAT and are continuing to grow and not part of the annuity payment, if those grow beyond what you initially put in, then all of that gets excluded from paying estate taxes on it, essentially. So if you put some high appreciating stock in there, or whatever asset that maybe a business or something like that, and it continues to grow, then all of that growth gets excluded from estate taxes.
Yeah, that's right. The from a tax perspective, as far as gift and estate taxes, the value of the gift that you're making from a tax perspective is frozen at the time of contribution to the GRAT. So any future appreciation, like you said, Stephen, gets passed on tax-free.
What about the legality of this? Are we are we tiptoeing around some gray areas, some areas that are going to get flagged by the IRS and that sort of thing? What's the IRS ruling, court cases? What's come up out of this?
Yeah, there's a very notable court case which actually involved the Walton family, so the family that founded Walmart a long time ago and has several people listed on the Forbes list and Bloomberg list and any list of billionaires. You're going to see at least a handful of Waltons on there. And so the Walton family actually won a court case over the taxing authorities in court that basically justified or clarified the legality of this zeroing out approach. So that's how the Walton family and many others have been able to pass on assets and wealth to the next generation without using up or paying any gift or estate taxes. And I think Bloomberg News, or one of the main outlets, has estimated that this strategy, zeroing out grats, has actually cost the IRS tens or hundreds of billions of dollars. So it's definitely something that's been well used at this point by many of the wealthiest people on earth. And based on the ruling in that Walton case, is something that is totally legal and allowed under the current legislative environment.
Mm-hmm. Yep. So thumbs up from a legality perspective. It's definitely something that's been tried and true. And obviously there's a cost to setting this up. So having the right estate planner, CPA, and just the cost of running this trust and setting up the annuity payments and that sort of thing, which can get expensive. So we're not trying to say that it's just a costless exercise. But obviously, if you're talking about spending maybe millions and millions of dollars to the U.S. government in estate taxes, then it might be something that is well worth the effort. All right. So, Matt, let's walk through an actual example of this. I think this might be really helpful for people to check out.
Yes. So I got my examples here. Can you see my screen, Stephen?
Yes, looks good. And
yes.
Apologies to those who are listening on the podcast. We'll try to describe it in as detail as possible. But check out the YouTube if you want the actual visual of what's Matt sharing here.
Yep, that's a good call, Stephen. I'll try and walk through it so it makes sense on audio as well, but definitely check out the video if you want the full visual, obviously. So I'm going to walk through 3 different examples here which help break down the mechanics of the GRAT and how they work. So in example number 1, which you can see right here, the GRAT is being funded with $10 million. So that could be cash, that could be real estate. More often than not, at least in the examples that are publicly disclosed, like we'll see here in a second, these are stocks of publicly traded companies, although you can use private companies as well. So lots of different assets that can be used. But for the sake of this example, let's just say it's NVIDIA stock. So somebody's setting up a GRAT with $10 million of NVIDIA stock, and the IRS rate that is used to determine the value of the gift and the value of the annuity is, I think technically right now it's 4.8%. I rounded up for simplicity to say 5%. And just for clarity, that rate that the IRS uses is actually based off of U.S. Treasury rates. So in general, where rates are does have a factor on whether GRATs are more or less attractive, which we can walk through more later on. But for now, let's use 5% as the IRS rate used to determine the value of the gift and the annuity. So that's the IRS rate. The return that we're assuming on this $10 million asset being contributed, which again, let's just say is NVIDIA stock hypothetically, we're assuming 20% for the return on that asset per year for the length of this GRAT, which we're assuming has a 10-year term to it. The payment that's coming back to the grantor who's putting in the $10 million, we're just going to simplistically assume for this first example is $1 million a year. So somebody puts in 10, gets back $1 million a year, so they're break even, ignoring the time value of money. And based on those numbers, the value of that annuity is $7.7 million. So somebody's putting in 10, getting back 1 per year. That annuity value, using time value of money, has $7.7 million of present value to it, which if you take the $10 million being put into the GRAT, subtract the 7.7 value of the annuity, you get a taxable gift amount of $2.3 million. So this person who's starting this GRAT is using up $2.3 million of their $15 million lifetime gift and estate tax exemption, or if they've already used up their exemption, they're paying, they have a taxable gift here being made of $2.3 million.
Just to jump in here, so just as a base case, you're putting $10 million away and you're only using up $2.3 million of
That's right.
every gift. So pretty beneficial
That's
just
right.
off the get-go.
Yep. Yeah, 100%. Like you said, super efficient, even using this current simple example, which we'll build on and improve on here shortly. But so $10 million goes in, starts the GRAT, grows 20% per year. So you pick up $2 million in appreciation, and then you get back your $1 million annuity payment. So at the end of the first year, the GRAT has $11 million left in it. And then that continues with the 20% annual growth minus the $1 million annual annuity payment, such that at the end of the 10-year term of this 10-year GRAT, you're sitting on $36 million of NVIDIA stock, again, using this example, which at this point is passed on to heirs without any additional gift or estate taxes being paid after that initial $2.2 million taxable gift. So pretty incredible way of passing on wealth free of additional gift and estate taxes beyond that annual gift amount.
And then the other thing is that those annuity payments, those don't have to be in cash. They can actually be valued in stock. So you can be transferring stock out of the GRAT as the annuity payment instead of just having to sell it and create cash. So
that's right.
Another efficient way of doing that.
Yeah, totally. The in-kind payments are very efficient, and we'll talk about that a little bit more in here in a second. So the first example, you put in 10, you get back 1 per year. So you break even without factoring in time value money. You use a taxable gift of $2.3 million, and you pass on 36 to your heirs, free of additional gift and estate taxes. So let's build on that here for a second with example number 2. And this is going to talk about the zeroing out aspect that we mentioned. So the same $10 million is being used to fund the GRAT, the same 5% IRS rate that we're using as we used in the first example, the same 20% annual return on the asset. But in this case, we're going to up the annuity payment from $1 million even per year to $1.3 million. So the value of the annuity that we're setting up is going to actually be $10 million in this example. So you're putting in $10 million, you're getting back a $10 million annuity. So from a tax perspective, you're not using any of your lifetime gift or estate tax exemption. So this is how the mechanics work of somebody zeroing out a GRAT, which again was proven in court to be something that is allowed by the Walton family a couple decades ago and has been used extensively ever since then. So in this example, you put in 10 million, you get 2 million of growth per year, you get back your $1.3 million annuity payment, and at the end of the trust term, there's $28 million of assets left in the GRAT, which can then be passed on to heirs free of any gift or estate tax ever having been charged on those assets.
Sounds pretty sweet.
I don't think it gets any more efficient than that from a gift and estate tax perspective. So this scenario here, example number 2 that we just walked through, is exactly why many of the wealthiest people in the world, and many others as well, are using this strategy to pass on wealth to future generations.
Good.
So one last example here to touch on. Example number 3, as you'll see in the heading there, which says tails we tie. So this strategy, GRATs, and including especially the zeroing out GRAT strategy, has been referred by some in the industry as a heads I win, tails we tie strategy, and pointing the limited or non-existent downside for the actual grantor in setting this up. So this will be the scenario where the GRAT doesn't technically work, which ends up being a tails we tie outcome. So the same $10 million is going in, the same 5% IRS rate is assumed, and rather than the asset being contributed, whether it's NVIDIA stock or something else, generating the annualized 20% return that we had in the first 2 examples, the return ends up only being 5%. And in this case, with the same annuity payment, the same annuity value, the same zeroing out effect, at the end of the 10-year term, based on the fact that the return of the asset matches the annuity rate being used here, there's actually a zero balance on the GRAT, which just means nothing gets passed on to heirs at this point, and the grantor just ends up in the same place they would have been if they never did anything in the first place. Because you put in $10 million of assets, you got it back with a 5% annualized return, and you end up with a no harm, no foul, tails we tie outcome here.
Yeah, so you're not worse off, but you didn't gain necessarily any estate tax avoidance in this scenario. So obviously you want to be thoughtful about what type of assets are being used in the GRAT, and the hurdle rate or the interest rate that the IRS puts out is also a big factor too, which fluctuates over time, obviously with rates.
Yes, and that's a great point, Stephen, because I meant to bring that up here as well, which is if you rewind the tape to COVID 2020, 2021, when rates were very, very low, the treasury rates that were used by the IRS to create that 75-20 rate, which is the hurdle rate for GRATs and other things within the tax structure, those rates were incredibly low, and therefore it became much easier to put in assets that were able to outperform that rate and therefore pass on wealth free of gift and estate tax. So when rates are low, all else equal, things like GRATs are more compelling and more valuable, and then vice versa. If that 75-20 rate was high single digits or low double digits, obviously it's going to be tougher to find assets that can consistently and reliably outperform that rate. So the rate environment in general and level of interest rates is definitely something to be mindful of when it comes to setting up GRATs.
Nice. Great. Let's can you pull up the real life example using
Yes.
Jensen from NVIDIA?
Yeah, so the hypotheticals we just walked through, we're putting in $10 million of NVIDIA stock. And this is, if you can see my screen on the video here, I'll walk through it for those on audio. But this is an SEC Form 4, which is a public disclosure made by public company executives whenever they buy or sell stock in the company that they work for, or have inside information on as an insider, whether it's a board member or something else. So in this case, this is Jensen, who is the CEO of NVIDIA, filing a Form 4 on March 18th of 2026. And there's a lot of pieces here that we're going to walk through, but let's take them step by step. So this first line here shows 438,000 shares of NVIDIA being disposed of, and that is simply the withholdings going back to the company on Jensen's RSUs that are vesting. So anyone out there who works at a public company and gets paid in RSUs knows what it's like to have shares withheld for taxes, and that's all this first line is showing. Obviously bigger dollars than most people, but just simply those shares being withheld on Jensen's vesting of his RSUs. And then this next three lines here are really where the rubber meets the road on the grats. So you'll see 29 million shares here being disposed. And you'll go over to the right here, and the nature of the ownership says by Grantor Retained Annuity Trust 1. And then the line below that is another 29 million shares by Grantor Retained Annuity Trust 2. And so what we're seeing here is these are two different grats that are reaching the end of their term. So 29 million shares are being moved from the grat to, you'll see down here, 29 plus 29 gets you 59 with round numbers. And so you're having two different grats that are reaching the end of their term, and the shares that were in those grats are right here being moved into an irrevocable remainder trust. So this is an example of what happens when the grat works out and the assets outperform, as certainly NVIDIA's stock has outperformed over the past 10 years. Then the assets get passed on free of gift and estate tax and get moved from the grat to the irrevocable trust that Jensen will presumably be using to pass on wealth to his heirs. And footnote 4 here is also interesting, which we'll see if we scroll down. The 29 million shares are being moved from the grats to the living trust, and that's net of a 31,000 share annuity payment being made back to Jensen and his wife. So just like Stephen said, as we were walking through the spreadsheet examples, you can use in-kind transfers. So the annuity payments in this case per year going back to Jensen from the grats were 31,000 shares of NVIDIA. So at current prices, that's like $5 or $6 million being paid from each of these grats back to Jensen and his wife in the form of NVIDIA stock. So I thought this was a cool real life example, I think just from last week, actually, March 18th, of a public company executive like Jensen using grats to pass on wealth in a very efficient way from a tax perspective.
So Matt, what are the costs of doing a grat? And obviously there's expenses for setting up these types of accounts and trusts, but just are there any gotchas or things that people need to be aware of?
Yeah, the biggest thing as far as risks and costs, in addition to just the administrative and legal fees for setting them up and documenting them and having the ongoing administration, the biggest risk is mortality risk, because if the grantor who sets up and funds the grat dies during the term of the grat, then the assets go back into the grantor's estate as if the whole thing was never set up, and therefore no estate or gift tax efficiencies are achieved. So the mortality risk involved with setting up grats is really the biggest risk from a tax perspective.
Okay. And we talked about compliance. Obviously, there's thumbs up from the IRS on this, but there's strict compliance that you have to abide by and follow in order for this to not run afoul of any rules and that sort of thing. So obviously there's some steps there. And then in regards to, can you use this for a generation skipping, or can this go to grandkids or anything like that?
No, that's another thing I was going to mention, Stephen. The rules are structured and set up in a way that grats are not an effective tool for passing wealth on beyond just the next generation. And the mechanics and specifics there are probably too much to get into on this episode, but just know that the way that they're structured as far as the rules and the taxes that get levied from a generation skipping tax perspective, these things don't work very well for that.
And then the last thing to mention is, because these assets are being transferred into an irrevocable trust, that means you avoid estate tax, but you don't get to step up in basis when the grantor or owner eventually does pass away. So no step up in basis, but you do avoid the estate tax. So I guess you win some, you lose some, Matt.
That's right.
All right. So finally, what are some other things? So we kind of know the basic structure of a GRAT. It's up for a term. You have to set a term. There's annuity payments and that sort of thing. What other things can you do in order to make them more effective? Obviously, trying to minimize the risks that we just talked about, especially the mortality risk.
Yeah, the biggest thing people do to minimize the mortality risk is really shorten the term, because you're allowed to set up terms, like we walked through examples that were 10-year terms. You're allowed to set up terms as short as 2 years. And so what a lot of people do is they'll set up what's called rolling GRATs. So rather than have one 10-year GRAT, you'll start 2-year GRATs each year for the next 8 or 9 years, such that you end up in the same place, but your mortality risk is significantly reduced. Because if you die in year 8 or 9 of a 10-year GRAT, then all the assets are included in your estate, like we already talked about. But if you die in year 8 or 9 after having used 2-year rolling GRATs, okay, well, you got several GRATs that reached completion successfully along the way, and therefore pass on wealth successfully free of gift and estate taxes. And so the mortality risk is addressed oftentimes by practitioners using rolling GRATs like this, with 2-year successive terms being used.
What else is there?
Yeah, so mortality risk can be addressed by using shorter terms and using a rolling GRAT strategy. The other thing I'll mention is having multiple or diversified GRATs. So if someone has a portfolio of 5, 10, 20 stocks, however many stocks, they could put them all into one GRAT, but at that point you have a risk of, okay, some of them do better, some of them do worse, and the drag from the underperformers ends up reducing the ultimate value that goes on to heirs. Versus if you did separate GRATs for each of the 5 or 10 or 20 stocks. So if you have 20 stocks, set up 20 different GRATs, fund each one with one of those stocks. Okay, well, in those scenarios where those stocks, for the handful or however many stocks that actually outperform the IRS rate, okay, well, those end up working and passing on wealth to the next generation free of gift and estate tax, whereas the ones that don't, okay, well, that's the tails we tie strategy. You get the assets back, and then you can use them to start new GRATs or put different assets or do any number of things. But having separate GRATs for each asset actually increases the odds that wealth is able to be passed on free of gift and estate tax.
Gotcha. Okay. So it seems like there's many ways to do this, to mitigate those risks, whether that's mortality risk of dying before the term's up, or maybe you have just limited concentrated positions and you don't want to just put them all in one trust, and you want to maximize the ability of their growth. So good stuff there, Matt. Well, I think that wraps up our GRAT episode. Thanks so much, everyone, for listening. Thanks to Kevin, our editor. If you want to hear more estate planning, financial planning, and investing topics, be sure to subscribe, and we'll see you next time.